Welcome to Market Brief After Hours. Today we are looking at a market landscape that has completely shifted gears. The recent rally that pushed major indices to record highs has hit a wall, and it is all stemming from a sudden spike in geopolitical tensions.
The cautious tone across the trading floor today was impossible to ignore. We are seeing renewed uncertainty surrounding U.S.-Iran tensions, and traders are really struggling to price in these escalating risks, particularly around the Strait of Hormuz. It's creating a sharp divide in the markets. Equities are softening, while energy and agricultural commodities are surging. It's a textbook example of a market pivoting from growth optimism to resource security and risk management.
Let us break down exactly how that played out in the major U.S. indices. We saw a pullback from those recent record levels across the board.
We did. The Dow Jones Industrial Average slipped by a marginal 0.01%, closing right around 49,443. The S&P 500 declined 0.24%, settling at 7,109. And the Nasdaq Composite fell 0.26% to finish at 24,404.
That drop in the Nasdaq is actually quite significant historically, isn't it?
It really is. That 0.26% decline officially snapped a 13-day winning streak for the Nasdaq. To put that into perspective, that was its longest winning streak since 1992. What we are seeing there is some natural profit-taking in technology stocks after a massive extended rally. But broadly speaking, for the S&P 500 and the Dow, this pullback reflects a pause in momentum rather than a structural shift. Investors are just taking a breath, digesting these geopolitical developments, and looking at elevated valuations with a bit more scrutiny.
Moving across the Atlantic, the picture in Europe seemed even more pessimistic.
Much more. European equities weakened broadly. The Pan-European Stock 600 fell 0.9%, and nearly every major sector ended in negative territory, with the sole exception of oil and gas.
Let us get into the specific country indices over there, because the sell-off was widespread.
It was across the board. In the UK, the FTSE 100 dropped 0.66%. France's CAC 40 lost 1.1%, and Germany's DAX 40 declined 1.2%. Looking further south, Italy's FTSE MIB fell 1.36%, and Switzerland's SMI dropped 1.06%.
What is driving that level of caution specific to the European markets?
It is a combination of factors, but the primary driver is the escalating maritime tension in the Persian Gulf. Europe is highly sensitive to energy supply disruptions. When you add fears over the durability of fragile ceasefires in the Middle East, it spooks European investors. Plus, the economic data provided a very mixed backdrop. Germany saw producer prices decline year on year, but they surged 2.5% month on month just from rising energy costs. Meanwhile, Eurozone construction output contracted again, and UK consumer sentiment hit its lowest level since mid-2023 because households are terrified of inflation risks tied to these higher energy prices.
That brings us perfectly to the commodities market. Energy prices reacted aggressively to this news.
Crude markets went into absolute overdrive. West Texas Intermediate surged 6.87% to $89.61 per barrel. Brent crude climbed 5.64% to $95.48. When military actions between the U.S. and Iran intensify into the Strait of Hormuz, the market immediately prices in the worst-case scenario for global shipping routes.
But it wasn't just energy. Agricultural commodities had a major day, specifically wheat.
Wheat is getting squeezed by both climate and conflict. Chicago wheat futures rose 1.2% to $6.0675 a bushel. Kansas City wheat futures gained 1.7%, which actually extends a massive 7.4% advance from last week.
What is the underlying cause for that massive jump in wheat?
It is a dual threat. We have severe dry conditions and drought risks threatening output in key U.S. plains growing regions. Combine that adverse weather with the renewed geopolitical tensions threatening global supply chains, and wheat becomes a prime beneficiary of the panic. Interestingly, corn edged up just slightly by 0.06%, and soybeans were flat, facing pressure from fast U.S. plantings and a softer long-term demand outlook from China. But for wheat, the near-term pressures are pushing prices straight up.
We are going to take a quick break right here. When we come back, we will dive into the currency markets, check those all-important moving averages, and look at the single stocks making huge waves today. Stay tuned. Welcome back to Market Brief After Hours. Before the break, we covered the equity pullback and the surge in commodities. Let us pivot over to Forex and look at the technical setups, starting with the euro to US dollar pair.
The euro is showing some real resilience. Euro USD closed at 1.1786, which is up 0.18% for the session. Technically, it is sitting in a very strong position. The pair is maintaining a firm stance above all its key moving averages. It is above the 50-day simple moving average at 1.1669, the 100-day at 1.1702, and the 200-day at 1.1673.
What does that alignment tell us about the broader trend?
It reinforces the strength of the underlying recovery. The price action is holding above a former resistance zone near 1.1700, which has now beautifully flipped to act as support. If it breaks immediate resistance at 1.1790, the path opens up toward the 1.1900 handle. The broader bullish structure remains completely intact as long as the price holds above that 200-day moving average.
Let us look at the British pound. How did GBP USD fare amidst all this volatility?
It held firm within its recent range. GBP USD closed at 1.3532, up 0.10%. Similar to the euro, it is maintaining a very stable technical footing. It remains above the 50-day SMA at 1.3422, the 100-day at 1.3449, and the 200-day at 1.3413. The 1.3450 area is acting as solid near-term support. If we see a move higher past immediate resistance at 1.3544, we could be targeting the 1.3650 region.
The Australian dollar also caught my eye today. It seems to be in a very strong uptrend.
Absolutely. AUD USD advanced 0.19%, closing at 0.7179, which was actually the high of its session. This pair is trading well above its moving averages. The 50-day is way down at 0.7044, the 100-day at 0.6894, and the 200-day at 0.6713. That is a confirmed strong bullish alignment across all timeframes. If it breaks above today's close, the door is wide open towards 0.7250 and potentially 0.7300.
Moving over to the Canadian dollar, we had some crucial inflation data drop today that impacted the USD CAD pair.
We did, and it pushed the pair lower. USD CAD extended its decline, closing down 0.31% at 1.3646. Canada's annual inflation rate came in at 2.4% for March. The market was expecting 2.6%. So even with higher gasoline prices from the Middle East tensions, the overall price pressures were softer than expected.
And how does the technical picture look for USD CAD after that data?
It reinforces a bearish tone for the US dollar against the loonie. The pair remains trapped below its moving average cluster. It is under the 50-day SMA at 1.3723, the 100-day at 1.3748, and the 200-day at 1.3816. We have seen repeated failures to break above those averages, so the downside pressure is definitely mounting.
Let us round out the technicals with gold. With all this geopolitical risk, how is the ultimate safe haven behaving?
Gold is actually in a period of consolidation. It closed at $4,814, down 0.48%. It is currently sitting below its 50-day SMA, which is at $4,894. However, it continues to hold above the 100-day SMA at $4,706 and the 200-day SMA at $4,198. So the broader uptrend is still intact. A break back above that 50-day average would signal a return to bullish momentum, but if it slips below the 100-day, we could be looking at a deeper correction.
Let us shift gears and look at the specific companies making headlines today. We had a massive acquisition announced that really moved the needle.
A massive one indeed. TopBuild Corp surged more than 19% today. This came after QXO Inc. announced it will acquire TopBuild for $17 billion. That breaks down to $505 per share. It is a significant premium, and it provided a massive boost to investor sentiment around that specific stock, even on a down day for the broader market.
On the flip side, the aerospace sector took a bit of a hit with a failed launch.
Yes, AST SpaceMobile fell more than 5%. Their New Glenn rocket unfortunately failed to correctly place a satellite into its intended orbit. In the space sector, successful deployments are everything, so the market was quick to penalize that operational failure.
We talked earlier about oil prices surging nearly 7%. How did that impact the travel and leisure stocks today?
Exactly as you would expect. They took a beating. Fuel is one of the largest operating expenses for these companies. Airline and cruise operators declined sharply.
American Airlines and Alaska Air both fell over 4%. Norwegian Cruise Line dropped more than 3%. And it wasn't just in the US. European travel stocks weakened too. Lufthansa fell 3.4%, EasyJet declined 3.1%, and TUI dropped 3.1%.
Were there any bright spots in the equity market today to help offset those losses?
Software stocks really stepped up. They outperformed and provided some much-needed support to the broader market, which helped limit the overall losses on the indices. Atlassian had a fantastic day, rising more than 7%. ServiceNow and Workday also posted solid gains, both adding over 3%. It shows that investors are still willing to allocate capital into high-margin tech names, even when macroeconomic fears are running high.
It certainly highlights the divergence in the market right now. Geopolitics and resource security are driving the bus, and it will be fascinating to see how these tensions evolve in the coming days. That is all the time we have for today's market breakdown. If you find this useful, please follow Market Brief After Hours.